We've seen autos stall out. They've kind of stabilized but stalled out at subpar, meaning subnormal expansion rates. We're seeing capital spending come down. We're seeing consumer confidence relapse. Housing was starting to pick up its head and has relapsed again, certainly if you're looking at sales. So we've had a rolling recession, and now we seem to be in the all-at-once phase. As I'm sure you've noticed, the stock market's correcting quite significantly, the correction we've seen in the last week. Bond yields are falling fairly dramatically. Commodity prices are falling and in some cases breaking down. Yield spread, so the spread between high yield bond rates and treasury bonds, that spread is starting to gap out. So the fear is seeping into the markets in many ways and in many indicators.
Cathie Wood, an American investor and the founder, CEO, and CIO of Ark Invest, discusses the potential for an impending recession in this video. Major economies worldwide have reduced interest rates to between 1% and 0.25%. In the United States, rate cuts might be on the horizon at the next FOMC meeting in September, as the Fed held rates steady during the last FOMC meeting. As market prices decline following corrections in the bond and commodity markets, Cathie Wood asserts that this situation is not a repeat of the 2008 and 2009 recessions, despite rising fears driven by persistent inflation. This inflation has been exacerbated by the Fed's continuous rate hikes since 2022, aimed at controlling inflation. Cathie Wood explains the market implications and the impact on digital assets, particularly Bitcoin. As we bring you more clips from the interview, take a moment to like the video, subscribe to the channel, and turn on post notifications for more video like this. You can join the conversation by dropping your thoughts, comments, and observations in the comment section below. Everything you do helps with YouTube algorithm and immensely contributes to the channel growth. Thank you and enjoy the video.
And we do have a point of view, and so I'd like to introduce it. You've heard it here before if you've been listening, but for those who haven't, I'm going to say this is slowly, then all at once. So we have been talking about the rolling recession that has been in place actually since the Fed started raising rates in 22. As soon as the Fed started raising rates, housing effectively went into a recession. Commercial real estate office was already in a recession. Now multifamily real estate seems to be an issue now. We've seen autos stall out. They've kind of stabilized but stalled out at subpar, meaning subnormal expansion rates. We're seeing capital spending come down. We're seeing consumer confidence relapse. Housing was starting to pick up its head and has relapsed again, certainly if you're looking at sales. So we've had a rolling recession, and now we seem to be in the all-at-once phase. Many people are beginning to understand, we think, that perhaps the idea that inflation is the problem has been misplaced. And this rolling recession is going to end with pricing coming down. So I've been saying the risk is deflation, prices coming down, and listening to Amazon's report last night, it's clear the consumer wants lower prices and is getting lower prices. The consumer is not falling apart yet. It's actually responding to some of the lower prices, even in autos. But nonetheless, falling prices, which is a problem for companies, it means their margins are going to compress. So the all at once has to do with deflationary signals. Now, This week we got the PMI, Purchasing Managers Index, and today the employment report. Both of those are recessionary. So this idea of we're in a recession is beginning to gain more traction. And in fact, the SOM rule in the unemployment report, basically the unemployment rate going up by 50 basis points as measured on a 3-month moving average basis relative to its low, that triggered. And so a lot more people are now thinking recession. Now, we're not thinking at all, when we say all at once, anything like 08, 09. In fact, the rolling recession part of this scenario would argue against that. So we're not at all suggesting that, but we are suggesting that this focus now on pricing power is going to be significant. And the reason it's significant is, in the early 80s, when Fed Chairman Volcker was trying to strangle inflation out of the system with double-digit interest rates, inflation was also at double digits. So if he was going to make a mistake, that was a big buffer to make a mistake. Our inflation rates today are much lower. And so the Fed actually has less room for error. And I do believe that higher for longer and thinking that inflation was the big risk out there has put us somewhat in harm's way. But half of the solution is understanding the problem. And so I think this cathartic moment is good. It's painful, very short term, these corrections are, because there's a lot of confusion. A lot of people have assumed that the world was going to work one way, and all of a sudden it's not. And one of the things you'll hear about increasingly in the news, I think, is the idea that the carry trade, which involves, believe it or not, the yen, is unwinding.
Another factor contributing to market fluctuations, particularly in the foreign exchange (FX) market, is the performance of the Japanese yen against the dollar. Japan recently raised its interest rate from 0% to 0.25% to address the yen's depreciation against the dollar. It is important to note that Japan's interest rate remains one of the lowest in the world. This increase has triggered significant sell-offs, and borrowers now face interest payments on their loans invested in dollar-denominated assets. Let's hear more from Cathie Wood on this.
So if you look at the carry, what people mean by the carry trade, it means that many investors and speculators borrowed yen. So they were effectively short yen. They borrowed yen because the interest rates in Japan were so low relative to the rest of the world. So they borrowed there and then redeployed those assets, put them into dollar-based assets or other currencies, but primarily dollar, often into our treasury bonds, which were yielding more. Now, since 2011, the yen has either been depreciating or stable. And so it was kind of safe if you were making the bet to short the yen or borrow the yen, that you weren't taking that much risk. And in fact, if the yen went down, you got the benefit of that, plus you were earning higher rates in the U.S. Some people think that part of the carry trade was by borrowing yen and then buying the Mag 6 or one of the broad-based benchmarks in the U.S., the S&P 500, the NASDAQ 100, both of which are very heavily populated and weighted with the Mag 6. So again, that we don't know how much of this went on. There are some guesses. A Deutsche Bank study suggested it could be $20 trillion. Now, think about that. Our GDP is roughly $25 trillion. So can you imagine this carry trade, which was becoming a consensus trade, to the tune of $20 trillion? I don't know if that's true or not. The other way to put it in perspective is I believe the global equity markets today are priced at roughly $130 trillion. So $20 trillion in the context of $130 trillion is also a very large trade in the market. So we don't know the exact number. It does make sense watching how violently the yen is actually appreciating now that this carry trade is unwinding. So people who had bet on the yen continuing to depreciate are changing their spots. They're cutting their losses, or they're getting margin calls and are having to sell. Since really the 08-09 crisis, so we mark it maybe at 2011, 2010. In the private equity, private credit world, there was a reach for yield in a very low interest rate environment. And so a very big trade, we believe, has been private equity and credit moving into the multifamily space. Rents were good yields, leveraging them up. And so that's another source of debt that we're watching. Now, private equity, private credit very often package this debt up. And many people say, oh my goodness, could this be a replay of 08-09? We do not think so. What happened back then was subprime mortgages were packaged into AAA instruments. That should have never happened, but the rationale was home prices across the country had never gone down. Pockets would go down, but nationally never gone down. Of course, that changed in 08-09. I don't think we're in a repeat of anything like that. It's more commercial real estate specific. And if we use a marker like in 1986, when I guess the tax laws changed and took away the tax shelter status of real estate, it hit commercial real estate very hard. But the rest of the economy was spared. So just want to, when I say slowly and then all at once, there are some trades that are going to unwind here, but we don't think that anything systemic will take place. What we do think, though, is this idea of deflation, prices coming down. That is something unusual, something we haven't experienced for a long period of time in terms of the aggregate price level. And, you know, 1 month does not a trend make, but the CPI did drop 0.1%, while the PPI was up 0.2%. That represents a margin squeeze for consumer-oriented companies. And we do think falling prices, especially because they're not expected, are going to hit margins. And this is where we come in, and I'll get back into this toward the end of this in the know. But innovation solves problems, and we think that artificial intelligence is going to solve a lot of margin problems. It's going to enable increasing productivity, significant increases in productivity. That might mean in the short term more unemployment, but we don't think it's going to get out of control.
That's our video for today, featuring Cathie Wood, the CEO and CIO of Ark Invest. Cathie provides insights and clarity on the current developments in the stock market and recession tendencies. Do you believe the anticipated rate cuts by the Federal Reserve will positively impact the pricing of risk assets? Share your thoughts and observations in the comments section below. Don't forget to subscribe to the channel and give this video a thumbs up. Thanks for watching.